In this video, we show you the best proven strategy using the stochastic indicator. The stochastic oscillator is a momentum indicator that shows the location of the closing price relative to the high-low range over a set number of periods. It was developed in the late 1950s by George Lane and is widely used to identify overbought and oversold conditions. It can be used to find low and high levels on the chart. Oversold and overbought refer to these two levels. As you know, the RSI indicator works similarly. Here you can see the RSI indicator, and here you see the stochastic indicator. The difference between these two indicators is that the stochastic gives you more signals, while the RSI gives fewer signals. This is why the stochastic is often used in lower time frames like 1 minute and 5 minutes for scalping. However, from my experience, I recommend using higher time frames like 30 minutes or more. The stochastic has two levels, the 80 line and the 20 line. The %K line and the %D line can give us additional signals. Step 1. Identify overbought and oversold levels. The main theory is that when the %K line crosses above the 80 level, it signals that the market is potentially overbought. Conversely, when the %K line drops below the 20 level, it signals that the market is potentially oversold. Step 2. Look for crossovers. A buy signal occurs when the %K line crosses above the %D line in the oversold region, below 20. A sell signal occurs when the %K line crosses below the %D line in the overbought region, above 80. The problem is that when we use only the stochastic indicator alone, we don't get very precise signals. Here, I'll show you some examples why. Here you can see the stochastic making a crossover under the 80 line. This might be the correct signal for a sell trade, but as we can see, this signal was not right. There are more signals that are not correct, as you can see here. But don't panic. If you use the stochastic in combination with other indicators, it becomes a powerful tool. Now, let's talk about a powerful combination, the stochastic oscillator and moving averages. By combining these two indicators, we can filter out false signals and improve the accuracy of our trades. I've set the moving average on my chart and set the length to 200. Step 1. Identify the trend with the moving average. For a buy trend, the line needs to be upward. For a sell trade, the moving average line needs to be downward. Now we combine these signals with the stochastic. As you know, the main strategy of the stochastic is that we sell when the stochastic crosses down from the 80 line, and we buy when the stochastic crosses up from the 20 line. Our confirmed signal is then 1. The moving average needs to be in the trend direction. Moving average in the buy direction means only stochastic buy trades. 2. For sell trades, the moving average needs to be in the trend direction for selling. Moving average in the sell direction means only stochastic sell trades. As advanced traders on this YouTube channel, we add something more to this strategy that's very easy. We draw support and resistance lines or trend lines on our chart, which improves our strategy. Here you can see now that we are looking for a buy trade. All three scenarios are right and we can make our buy trade. As you can see, the signal is very clear and it worked. Now, let's make a sell trade. Again, the signal is clear. We wait to confirm the moving average for a sell direction, the stochastic for a sell crossover below the 80 line, and draw a trend line to improve our signal. Here you can see now that we are looking for a buy trade. All three scenarios are right and we can make our buy trade. As you can see, the signal is very clear and it worked. Now, let's make a sell trade. Again, the signal is clear. We wait to confirm the moving average for a sell direction, the stochastic for a sell crossover below the 80 line, and draw a trend line to improve our signal. And again, this sell signal was a good one. Now, let's discuss where to set our take profit and stop loss. Before we move to this section, we want to let you know that we've created a PDF file for you which explains this stochastic strategy in detail and in simple terms. This way, you'll always know how to make trades with this strategy. You can find the link to the PDF in the description below. If you like this video, please give us a thumbs up and subscribe to our channel. For take profit and stop loss, we use this simple rule. When the stochastic is at the 80 line, we close all our buy trades. We recommend that when you make trades, you aim to have at least twice your risk as your potential reward. This means that even if you have losing trades, which can sometimes happen, your overall winning trades should be higher, making you profitable. For sell trades, we close our trades when the stochastic is at the 20 line. We set the stop loss at the last support line for a buy trade. For a sell trade, we set the stop loss at the last resistance line. Here are some more examples where we can set our stop loss. I show you this because support and resistance can look different sometimes. Now you have learned how to use the stochastic strategy. 1. Use the stochastic in combination with a moving average. When we are looking for a buy trade, the moving average needs to be in an uptrend. For a sell trade, the moving average needs to be in a downtrend. 2. Set the take profit for a buy trade at the stochastic 80 line. Set the take profit for a sell trade at the stochastic 20 line. 3. Set the stop loss at the support and resistance lines. 4. Use higher time frames to increase the success rate. We hope this video helped you understand this strategy better. Don't forget to check the PDF in our description. Let us know in the comments if this video was helpful. See you in the next videos.